Matt Common, thanks for joining us.
Pleasure.
Congratulations on some pretty good looking results. You've had a back to basics strategy focusing on the retail bank that seems to be working out for you.
We've been very focused on delivering better outcomes for our customers, investing in our digital and technology, and even though our profit was down 4% on last year, it was well received, mainly because I think we've performed quite well given the operating context.
In particular, this 4% growth in home loans to December, that's about 1.5 times ahead of the system. How have you achieved that?
Yeah, during the period we've made sure that we've invested in both the technology and as well as our processes, ensuring that we're giving a faster turnaround time and speed of decision to our customers so they can get certainty if they're purchasing a new property. The focus on that has meant that we've actually competed very well against other financial institutions, and so as you mentioned, our growth was 1.5 times system over that period, which is unusual given our size.
You've also seen a 1 basis point improvement in the net interest margin. How have you managed to achieve that in such a low interest rate environment?
Yeah, it was pretty flat over the period. One of the big benefits during the 6 months was what's referred to as the cash bill spread, and that contracted quite sharply, which gives us a benefit at the group net interest margin level. So notwithstanding lower interest rates, which again we guided the impact that will have on the full year and particularly in the second half and going into FY21 and 22, it was offset from just a change in the funding costs in this particular period.
You say you want to lend, you're ready to lend. Obviously, interest rates are at record lows. That's very good for borrowers. What do you see the hold-up is in the market? Because volumes are still pretty low.
Probably less reliant than a number of other institutions, but I think we've been able to navigate well through an evolving regulatory guidance. We feel very confident about what's required from us to comply with responsible lending. As I said, we've been very focused on making sure we manage those changes well and that our customers aren't impacted and they're receiving very high levels of service from us, and that's been rewarded with an increasing proportion of customers coming to us and enabling us to help them purchase a home, which we really appreciate, and that's enabled us to grow faster than system.
You say you want to lend, you're ready to lend. Obviously, interest rates are at record lows. That's very good for borrowers. What do you see the hold-up is in the market? Because volumes are still pretty low.
You know, in our experience, as you said, the housing market has picked up, particularly at the back half of last calendar year. We saw that in house price increases, quite strong house price increases, particularly in Sydney and Melbourne, to a lesser extent Brisbane. We've seen strong increase in applications and fundings, particularly for customers who are purchasing their own home, first home buyers. And so while the credit growth itself hasn't increased by as much, that's really been a function of many existing borrowers, and understandably in a lower interest rate environment, have been happy to continue to repay their loan off faster, and that's reduced their overall balance. So we feel that the housing market at the moment is in quite a good equilibrium. We're not seeing excessive credit growth, we're not seeing too much investment lending that's going into it. House prices have stabilised. I think that's good for broader confidence, and we've been able to operate effectively within those environments.
Now, the RBA was pretty sensitive about its own decision to continually cut interest rates. Some criticism it could lead to some riskier borrowing. Are you confident that you have the protections in place to prevent that?
I am. I'm very confident about the overall credit quality of our portfolio, and that was again something that we highlighted today. Some of the key ways that you look at that is through arrears rates across all of our consumer portfolios. They reduced over the 6 months. So we're very confident about the quality of the home lending and business lending that we're writing. But you're right in the broader context of low interest rates, of course, can stimulate additional investment and certainly in financing. And so that combination of both what happens in the employment market, which of course unemployment is very low, provided that continues to be the case, we don't see an acceleration too much in credit growth. We don't see house prices accelerating from where they are, because on the other side of that, of course, housing affordability is a really important issue. So provided that balance is quite similar to where it is today, then we have no immediate cause for concern. But if we started to see an acceleration in credit growth and housing, as we did particularly going into 2015, then that would be a concern for us and of course a number of our regulators.
And what of interest rate cuts, Matt? Some people were pretty surprised that the RBA took the extent of the action it did last year. Do you foresee another cut? Because as you said, unemployment is still pretty low.
Yeah, I think overall people would say the economy is doing quite well, and the RBA has been clear that they'd like it to be doing a bit better. I hope that the economic performance of Australia, notwithstanding some of the risks and uncertainty from coronavirus in the near term, doesn't weigh too heavily on sentiment, and further cash rate reductions aren't necessary. I think the RBA have taken a very deliberate path to try and stimulate the Australian economy, and their primary mechanism for doing that is through the cash rate. So I think it's fair to say there's probably still a bias to easing from here. But my ultimate hope is that in combination with businesses doing well, continued labour market, further investments in infrastructure, the housing market continuing to stabilise, there's enough economic momentum in Australia to mean that the interest rate environment doesn't need to be reduced from here.
Now, Matt, you talked about some of those threats to the economy. You mentioned the coronavirus, but another one has been the bushfires. We've had this devastating summer. You've put $100 million aside in provisions as a result of the bushfires. Tell us about that.
Yeah, we put aside, and we mentioned today, $83 million of insurance claims, but also a separate $100 million on top of that for potential loan impairment resulting from both the drought and bushfires. We've been watching that very closely, and of course the tragic events that have unfolded over the summer. I think the RBA's analysis in the context of, yes, it certainly has an impact in the near term, and when we've studied previous natural disasters, that's largely been the case because there are significant investments in the recovery. And of course, we're really committed to making sure that we're helping all of our customers recover and rebuild those affected communities.
Yeah, and some of the viewers at home with shares obviously be interested in the dividend. Your decision on there to keep it flat?
Yes, given the performance that we've been discussing, as well as a very strong capital position, really the Common Equity Tier 1 being well above the APRA's 10.5% are unquestionably strong. We were able to declare a fully franked interim dividend of $2, which is flat, and also that we will be neutralising the dividend reinvestment plan.
Matt, we're about a year on from the end of the Royal Commission. Do you think your bank, the CBA, has changed in that time? How has it changed, and how has banking changed in Australia as a result of the Banking Royal Commission?
Well, I think both have changed significantly, and I see that as the chair of the Australian Banking Association. I see the commitment from all of my fellow CEOs of their respective institutions, how much work was required and their deep commitment to it. And that's certainly been the case at the Commonwealth Bank. I by no means say that work is over. Part of our results, we released an update on our response to the Prudential inquiry, how we're going on the implementation of various Royal Commission recommendations. And so I'd say a year on, as you said, we're making very good progress. I think there's a number of very clear differences, including some of the changes that we've made to fees and pricing, which is one of the reductions in our overall profit today, down $415 million. And that's savings for our customers. So I feel substantial change, but still more work to do, and we're absolutely committed to making sure that happens.
Now, you've been forced to put aside hundreds of millions in remediation costs so far as a result of the Royal Commission and other scandals. Do you think you've hit the high water mark in terms of these costs? Are you through the worst of it?
Hopefully. Much closer to the end to the beginning, and of course these remediation provisions should never have been necessary. What I said today was in the first 6 months we paid out another $100 million to customers, the majority of that to wealth customers, some banking refunds and remediation and that as well. And the majority of the remaining compensation is really set aside for what's known as the aligned advice or financial advisors, the ongoing service fees. And we are committed. We've got a very large team working on customer remediation to try and complete that as quickly as possible.
Matt Comyn, thanks for joining us.
Pleasure. Thank you.